James retired at 62 after 31 years as an engineer in Florida. James retired at 62 after 31 years as an engineer in Florida. He had a pension, a healthy IRA, and a plan. His financial advisor told him the plan was solid. His accountant signed off on it every April. And for 3 years, everything looked exactly the way it was supposed to look. Then he turned 65 and enrolled in Medicare. The welcome letter arrived the same week. But it was not the letter he expected. It was not a card from the government congratulating him on a new benefit. It was a premium notice. And the number on that notice was not the number he had ever seen quoted anywhere. The standard Part B premium he had read about was $185 a month. The number on James's letter was $443.90 per month, per person. And his wife received the same letter the same week. Together, they were paying $517.80 more every single month than they expected. That is $6,213.60 more every single year. Not because James did anything wrong, because he made $1 too much in 2024. James is not unusual. His story is the story of hundreds of thousands of retirees every single year. People who saved carefully, followed the advice they were given, and had no idea that Medicare uses a 2-year look-back window to calculate your premiums. Nobody told James that the income decisions he made at age 63 would determine what he paid for health coverage at 65. His advisor did not mention it. His accountant did not flag it. The articles he read never put a real dollar amount on it. Most people find out the same way James did, after the letter has already arrived, after the money is already gone, after the window to do anything about it has already closed. This video is for educational purposes only and is not tax or financial advice. Before making any changes to your retirement income strategy, consult a qualified tax professional or financial advisor who knows your specific situation. My name is Kevin Retires. Every week I break down the tax rules, the Medicare traps, and the financial mistakes that are quietly costing retirees thousands of dollars a year. Things your advisor should have told you and probably did not. If that sounds like information you need, hit subscribe right now and turn on notifications. I put out a new video every week and you do not want to miss what is coming next. Today I am going to show you exactly what IRMAA is and why it works the way it does. I am going to walk you through the 2-year look back in plain English so you understand exactly which year's income is setting your premiums right now. I am going to show you a real married couple example with the actual 2026 numbers so you can see what crossing each threshold costs in real dollars. Then I am going to give you a clear action plan based on how old you are today, because what you need to do right now depends entirely on where you are in this window. Let me start with the foundation. Medicare Part B covers your outpatient care. Doctor visits, lab work, preventive services. Most people know they will pay a monthly premium for it. What most people do not know is that the premium is not the same for everyone. The amount you pay for Medicare Part B is based on your income. Not your current income, not last year's income, your income from 2 years ago. Medicare calls this the Modified Adjusted Gross Income Lookback. You enroll at 65. Medicare looks at your tax return from 2 years prior to set your premium. Every year after that, the same thing happens. The premium you pay in 2026 is based on your 2024 tax return. The premium you will pay in 2027 will be based on your 2025 tax return. This never stops. It runs for the rest of your life on Medicare. If your income was below a certain threshold, you pay the standard premium. In 2026, that standard premium is $185 per month per person. If your income crossed the first threshold, Medicare adds a surcharge. That surcharge is called IRMAA. It stands for Income-Related Monthly Adjustment Amount. And here is the thing that makes IRMAA genuinely dangerous. It is not a gradual increase. It is a cliff. Cross the first threshold by one single dollar, and your entire premium jumps immediately to the next tier. There is no sliding scale. There is no transition. $1 over the line, and you pay the full surcharge for that entire tier, every month, for the entire year. In 2026, the IRMAA income thresholds work like this. For married couples filing jointly, if your modified adjusted gross income from 2024 was $212,000 or below, you pay the standard $185 per month. If it was between $212,001 and $266,000, your premium jumps to $259 per month per person. Between $266,001 and $334,000, it jumps to $369.20. Between $334,001 and $400,000, it goes to $443.90. Above $400,000, it reaches $517.40 per person per month. For single filers, those thresholds are roughly half those amounts. Let me put that in annual terms for a married couple where both spouses are on Medicare. At the standard rate, the two of them pay $4,440 per year combined. Cross the first IRMAA tier by $1, and they pay $6,216. That is a $1,776 jump, because of $1. Cross the second tier, and they pay $8,860.80. An additional $2,644.80 over the first tier. Cross the third tier, and they pay $10,653.60, nearly $10,000 more per year than the standard rate. These are not hypothetical numbers. These are the actual 2026 Medicare Part B premium rates. Now let me show you what this looks like in 3 real situations. 3 people, 3 different decisions, 3 completely different outcomes. Margaret is 67. She retired at 64 after a long career in healthcare administration. She and her husband have a combined pension income of $160,000 a year, and they take IRA distributions of $40,000 a year. Their total modified adjusted gross income is $200,000. They are under the first IRMAA threshold. They pay the standard premium, $185 each, $4,440 combined for the year. Now here is what Margaret's neighbor Richard did. Richard is also 67. He and his wife have the same pension income as Margaret, $160,000. But Richard decided to do a Roth conversion last year. He converted $55,000 from his traditional IRA to a Roth IRA. He paid the income tax on the conversion. His advisor told him the conversion was smart and tax efficient. He agreed. He did it. What Richard's advisor did not account for was that the conversion pushed his modified adjusted gross income from $200,000 to $255,000. Still under what looks like a comfortable ceiling. But $255,000 lands in the second IRMAA tier, not the first. Richard and his wife are now paying $369.20 per person per month. That is $8,860.80 per year combined. They are paying $4,420.80 more per year than Margaret. Because of a Roth conversion decision made 2 years ago that neither Richard nor his advisor connected to his Medicare premiums. And that cost is on top of the income tax Richard already paid on the conversion. The IRS and Medicare calculate these costs completely separately. You can make a tax-efficient conversion by one measure and still trigger thousands of dollars in extra Medicare costs by another. They do not talk to each other. They do not offset each other. They stack. Now let me show you the third situation. This one is James. James and his wife had a combined income of $210,500 in 2024. Pension income, Social Security, and a $45,000 IRA distribution to cover a home repair. They were not trying to cross any threshold. They were not thinking about IRMAA at all. They were thinking about a leaking roof. Their 2024 modified adjusted gross income was $210,500. The first IRMAA threshold for married couples filing jointly is $212,000. James and his wife were $1,500 under it. But James's wife sold a small piece of inherited land in December 2024. The capital gain was $2,400. Clean, simple transaction. She paid the tax on it. Done. Their modified adjusted gross income became $212,900, $900 over the first threshold, and that $900 cost them $1,776 in higher Medicare premiums for all of 2026, every single month, $74 per person in extra premium, because of a land sale that netted $2,400. The Medicare surcharge ate nearly 3/4 of the profit from that transaction. James did not know this was coming. His accountant filed the return accurately. The capital gain was reported correctly. Nobody did anything wrong. But nobody modeled what that transaction would do to Medicare premiums 2 years later. Now I want to talk about 3 mistakes that slam this window shut before people ever get a chance to use it. The first mistake is treating income decisions as isolated events. Most retirees think about each financial move on its own terms. The Roth conversion is evaluated for its tax efficiency. The home sale is evaluated for its capital gain. The IRA distribution is evaluated against the tax bracket. What nobody does is look at all of them together in real time against the current year's IRMAA thresholds. Because the damage does not show up for 2 years, the connection between the decision and the consequence is invisible. By the time the Medicare letter arrives, the year that created the problem is already long past. You cannot go back and undo an IRA distribution from 2 years ago. The second mistake is ignoring what IRMAA does to Roth conversion math. Roth conversions are genuinely powerful tools. Moving money from a taxable account to a tax-free account is a real strategy with real long-term benefits. But the math that most advisors present only accounts for the income tax on the conversion itself. It does not account for what happens to Medicare premiums 2 years later if the conversion crosses an IRMAA threshold. A $50,000 Roth conversion that costs you $11,000 in federal income tax and $4,420 in additional Medicare premiums over the following year cost you $15,420 total. That changes the break-even analysis completely. Not every conversion is a bad idea, but every conversion should be modeled against the IRMAA thresholds before it is executed, not after. The third mistake is assuming that once you are on Medicare, the window is closed and nothing can be done. That is not entirely true. Medicare has a process called IRMAA reconsideration. If your income has dropped significantly since the year Medicare is using to calculate your premium, you can request a review. This applies to specific life-changing events: retirement, reduction in work hours, divorce, death of a spouse, loss of income-producing property. The form is SSA 44. Most people who qualify have never heard of it. If your income 2 years ago was high because of something that no longer applies, you stopped working, you sold a property, you had a one-time distribution, you may be eligible to have your premium recalculated based on your more recent income. It does not apply to every situation, but it applies to more situations than Medicare ever advertises. Here is the action plan based on exactly how old you are right now. If you are under 63, you have real planning time. IRMAA is not a current threat, but the habits you build now will determine how exposed you are when you get there. Start tracking your modified adjusted gross income every year against the current IRMAA thresholds. Understand which income sources count: wages, pension income, IRA distributions, capital gains, rental income, interest, dividends. Understand which ones do not: Roth withdrawals from accounts held at least 5 years, life insurance proceeds, gifts. Build a picture of what your income landscape will look like at 63, 64, and 65. That picture will tell you where the risk is before the window becomes urgent. If you are 63 or 64, you are in the most critical window of your pre-Medicare life, and most people in this window do not know it. The income you report on your tax return this year and next year directly sets your Medicare premium for the first 2 years you are on Medicare. Every financial decision you make between now and December 31st is either protecting that premium or inflating it. Before you take any IRA distribution, do any Roth conversion, sell any appreciated asset, or take any other income-producing action, run the IRMAA numbers first. Know exactly where your modified adjusted gross income sits against the current thresholds. Know how much room you have before the next tier. Make every decision in that context. If you are 65 or 66 and already on Medicare, the income that set your current premium is locked in. You cannot change 2024 or 2025, but you can do 2 things right now. First, check whether you qualify for an IRMAA reconsideration using Form SSA 44. If your income has dropped because of retirement, a one-time event, or any qualifying life change, you may be able to have your premium reduced. Second, start managing this year's income carefully, because this year's return will set your premium 2 years from now. The window never stops moving. If you are already past 66 and have been on Medicare for several years, the framework is exactly the same. The look back never stops. Your 2025 tax return sets your 2027 premium. Managing your modified adjusted gross income is now a permanent part of your financial life, not a one-time enrollment concern. The retirees who understand this pay the standard premium for decades. The ones who treat each year's income in isolation get surprised by surcharges year after year. If you already received a high IRMAA notice for 2026 and want to see whether you qualify for reconsideration, go to ssa.gov and search for Form SSA-44. Download it, fill it out, and submit it with documentation of the life-changing event that reduced your income. If you are not sure whether you qualify, call the Social Security Administration directly at 1-800-772-1213. Do not assume you do not qualify until someone at SSA tells you that in writing. One more thing before I let you go. I want you to know what the dollar difference actually looks like across a full retirement. A couple on Medicare for 20 years who manages their income to stay at the standard premium rate pays $88,800 in Part B premiums over that time, assuming rates stay roughly where they are. A couple who crosses the first IRMAA tier for those same 20 years pays $124,320. That is $35,520 more for the same coverage. Not because they had more money, because they did not know about this rule in time to manage around it. That is exactly why this channel exists, not to scare you, to put specific numbers on specific rules so you can make specific decisions before the letter arrives. Leave me a comment below and tell me this. Did you know about the 2-year look back before watching this video? I read every comment and I want to know how many people are finding out about this for the first time right here. If this helped you, hit the like button. It takes 2 seconds and it tells me to keep making videos exactly like this one. Subscribe if you are not already, and turn on the bell so you do not miss the next one. Next week I am covering the one Social Security timing mistake that costs married couples more than any other single decision in retirement. You do not want to miss that one.